I want to know, let me ask you again, do you know what a black box manufacturer is? Yes?
It's a contractor that helps you find manufacturing.
Exactly, yes. So now you know something you didn't know 10 minutes ago. Okay? All right? So the purpose of this lecture is for you to go out knowing something different. Are you with me? Okay? So I'm here to try and give you new ways of understanding old things and new examples that you may not be able to find on YouTube. Okay? So let me just repeat again. I spend a lot of time preparing for the lecture and to try and make it clear for you. So you have some choices. You don't have to come to the lecture. You will not lose any marks, okay? But if I see you in the lecture texting with a phone or something else, then I might ask you to leave, okay? Because there's plenty of other things you can be doing. I have to compete with these. So I guarantee I can give you something of value when you come to the lecture. Allow me just to turn the first light off. I apologise in the front. If it gets to, I don't know what's happened. Oh, it's on again. If it gets to, what do you call it? If it gets too dark in the front, then please let me know. I can wake you up. So what we're interested in here is we're interested in activity-based management implementation model. This framework is not in the textbook. This framework you will not see in any book. You Google this, you will not see this. Why? Because I designed it to help you understand what the big picture is about. I just want to spend maybe 1 or 2 minutes talking about the big picture. When you're studying Management Accounting 1, it's all about how do we allocate costs so they're more accurate. How do we allocate costs? How do we allocate overhead? Is that right? Yes. And maybe near the end of Management Accounting 1, I think, did we cover activity-based costing? Yes. And last week we said, activity-based costing again, right? And there may be something in activity-based costing at the start of Management Accounting 2. And this is all great. Wow. If some company has a cost problem, great. We just go in and allocate overhead better. Or we, let's do ABC, and that will solve your cost problems. And then you can march along and you can compete effectively and you will be profitable for life ever after. All right, how do you know? Oh, because the Horngren Management Accounting textbook says that's what you do. Okay? That's what we taught you in MA1. And that's what I repeated last week in MA2. There's your solution. Okay? That's it. All right? But I'll tell you, the real solution is not cost allocation or activity-based costing. That is not the real solution. Remember, 30% of the China suppliers I interviewed in the last 12 months said cost control is a major challenge. Do you think they don't know about activity-based costing? Do you think they don't know about Management Accounting 1? That's probably the last thing they need. Probably the last thing they need to make a turnaround, to make their operations more sustainable. Today's lecture is what they really do need. Okay? Today's lecture is the real medicine. It is the real medicine that can make a big difference. Seriously. So just try your best to listen to my funny talking or however you sense it is, all right? Just try your best for the next half an hour, have a short break, come back, go for another 40 minutes. I just want your attention, because I want to give you a real solution that you can go to these companies with. Activity-based costing is not a solution, it's just an allocation process. Activity-based costing does not change how you make a product. It does not change the components in a product. It doesn't change the design of a product. It doesn't change your processes. It doesn't change anything. It just shows management, oh, if you sell this type of phone, then you're going to make this one's going to be more profitable than this type of phone, so maybe you should sell more of this and less of this one. We'll try telling that to a manufacturer that has a portfolio of products, which most of them do. And they need a portfolio. Why? Because they don't know next year that growth in this area is going to be the same as it was in the last 5 years. And then next year, growth in another area that wasn't growing suddenly takes off. Why? Because the largest ordinary phone market in the world is not US and Europe. Do you know where it is?
China.
Ordinary phone. Ordinary, okay? Smartphones are getting big in China now. Okay? It's India. It's Africa. Okay? Over 300 million units are sold, and a lot of them are made just across the border in China. The average, you know the phone with 9 digits at the bottom? You know the phone that, as we used to see them? Yeah, they are big sales. 300 million are being sold each year. And you think, oh, that's old technology. But there are markets out there, and that market might be growing faster than other more developed markets. You see? Okay, so some of you have studied marketing, and so you're understanding this, because you're thinking, in marketing, you're just thinking, where is the next best growth channel? Where is the next best growth country or product positioning, right? That's what you're thinking in marketing. Today's lecture works backwards from that. Okay, today's lecture is not, we're not looking at this, activity-based costing, okay? That is not the medicine that will turn around a company. The medicine is in value engineering. The medicine is in here. There are 4 areas of value engineering. I'm going to cover 3 of them in today's lecture. They are the 3 that match the dominant learning objectives for this week. Okay, functional analysis, number 1. Okay, design analysis, number 2. And number 4 is process value analysis. Number 3 is dramatic re-engineering. Okay, so we're not going to cover that, all right? But I'm going to spend time at the end of today's lecture. You're going to know about what is functional analysis. You're also going to know is what is design analysis, and finally, what is process value analysis. If you know those 3 things, you're more likely to get an audience with a struggling company that is having problems with cost control than if you go there with the medicine of, oh, you should have activity-based costing. Okay, O'Connor told me in MA2. Okay, all right. This is the real medicine that companies need to turn around. Okay, so that's the focus of today. There are many learning objectives set out in the chapter assigned for Horngren. Okay, so 1 or 2 of the learning objectives we may skip over in order to hone in on the very important ones, and I'll tell you as we go through that. Okay, if you miss anything, I have 2 solutions. One is you bring a recorder to the lecture. Okay. The second solution is I have pre-recorded this lecture for you. Okay. So you have a copy that I can send to each one of you after today's lecture. It goes for 45 minutes. It covers the very important areas of your lecture notes. Okay. How many of you have flown on a cheap airline? Have we got a show of hands? Right, how does it feel? Do you have much room? No. No, not much room, all right. How many of you have flown on the regular airline? The regular, okay. A little bit more room? Yes. Did you get upgraded? No, it doesn't. Yeah, it's hard, isn't it? Only the professors get upgraded. Doctors. They think you're a medical doctor, but you're just doctor of philosophy, right? That always happens. Now, what you're also going to learn today is, right now we can ask, oh, where are they making the most savings? Well, 16% of the cheap airlines have made a lot of savings in the having more seats in the airline, just putting extra rows in. You know, the 737 salesman of Boeing said, well, we should only have 42 rows. No, I want 45 rows. I want 45 rows. We will not make any money if we don't have 45 rows. Okay, if you want them up like this, okay, we'll put in 45 rows. And along comes the 737, 45 rows, it becomes a cheap airline. We don't care. People want to get from A to B as cheap as possible. So that is a huge saving area for the low cost. 10% minimal station costs. That is a huge cost saving area for the low cost airlines. What you will have a greater appreciation of after today's lecture is the following. Here are the different cost strategies that the cheap airlines do. I just showed you which ones are making them the most money. What you'll be able to do after today's lecture is think about these strategies in terms of the three areas of changing product function, changing product design, or changing the process. You see, that's important. It's important to know two things, that what we have to do. This is what we have to do. What is also important is this a function change, a design change, or a process change? Because the people in charge of these three areas may be different. So if you're in charge of a company, you know what to do. You need to know how to do it. Why? Because you need to know who to talk to or how to get the teams together to execute. Okay, so this is all about execution. It's all about, you know the strategy, but knowing this will help you execute the strategy. Okay, the big picture, as I always remind you every week, we are over in this area here. Okay, I've repeated this a few times, so we'll come back to that. Okay. Just a short reminder, how many of you have got this example in your notes? This example was just to remind you again that in the old unit you studied, Management Accounting 1, we had direct material, labour, overhead. Our total manufacturing cost was $4.20. You had an opportunity to sell extra tapes, and you had to make a decision, do we do it or not? Okay, 1,000 tapes at $4 a tape. Of course not, it costs us $4.20. Why would we want to make extra tapes and sell them for 20 cents less a unit, right? That's your Management Accounting 1 problem, okay? So just a reminder of where you're coming from for those who have forgotten the Management Accounting 1. And then you may be asked in Management Accounting 1, well, what would have been the effect on monthly operating income? Comment on the reasoning given by the President, and what other factors should the President consider before accepting the special order. Notice, this is calculation, these are assumptions, and these are externalities. These are assumptions that the President made about what is relevant, what is not relevant. So maybe just circle this. Circle number 2. This is assumptions about what is relevant, what is not relevant. So in Management Accounting 1, you were taught, relevant costs are? They change, right? They change over option. Number 2, they are in the past or future. They're in the future, okay? All right, and also whether they're fixed or variable. So it's a time frame, isn't it? But it's related to the changing, but in the long term, everything is variable. In the short term, many things are fixed. Yes. All right. So these are some of the things that the question is asking you to talk about. All right. And so there you have the calculation, and then this calculation assumes that 1 and 2. In the exam, many management accounting exam questions have a calculation component, and then they have, okay, so tell us your reasoning or your assumption. Just be aware of the assumptions behind the principle that you have used in the calculation, okay? So I just want to skip through that, just to remind you where you come from, okay, where we're looking at relevant costs. There are the 3 key issues. You'll have this solution in front of you, is that right? You do, right? Good. That means I don't have to talk about it now, right? Okay, because I want to get on to the real juicy part of this lecture. And that is customers, competitors and costs influence demand and supply. As I said right at the start, companies are facing cost pressure. Most companies over time are offering the same product for higher price or lower price. It's one direction, especially in consumer electronics. It's always one direction. Maybe except Apple. With Apple, it's because they keep on bringing in better products, right, to keep that price point, all right? And because the old product price point is sort of going down, okay? So, customers, competitors can influence demand and supply. I speak to one of the major suppliers to HTC, and we asked that supplier what is the best situation you'd like to have in terms of competitors and you're supplying to HTC. We'd like to offer a product where there's only one other supplier. So then we can go to the customer. We can go to the customer and say, hey, take our product, then 2 advantages to you. Maybe you'll get cheaper from us, but even better still, here's our value proposition. You're sourcing from 2 suppliers now. Now you have more flexibility. You've got to think, if you're supplying to someone, especially it's intermediate good to a component manufacturer, you can offer them a value proposition of not that you're cheaper, but you're offering them flexibility. That's what customers want. Sometimes they want flexibility, not a cheaper price. So by adding that, by becoming the second supplier, you're introducing competition to the supply process. And of course, costs are always there, because when you talk to these big electronic manufacturers, every 3 months it's cost down 5%. That is the norm. That does happen. Okay? That's norm. All right? Remind you, this is what the China suppliers told me, 644 of them. And what you didn't know last week, you had a copy of this last week, yes? If there's anything up here that you don't have, please let me know. Okay. Cost control is very, very important. Here's the new thing for this week. That was news from last week. The thing from this week, here's the big question. What are they doing to manage the cost? Remember what I said. You don't go to these people with the activity-based costing or cost allocation medicine. You've got to go to them with something more. What are they doing? That may give us a hint for what they're really looking at, right? Let's see. Let me show you. Would you like to see what they are doing? Would you like to find out what these? There's about 200 here that are They got cost control pressure. What are those 183 doing? Okay. What are they doing? It'll be very interesting. What are they doing? They've got this pressure. What are they doing? Here's what they are doing. Okay, 212. Why? Because some are doing more than one thing. Okay, not just doing one thing, they're doing 2 things. Okay. Most of them, 14%, automating. Okay. 2, improving production efficiency. No activity-based costing there, right? It's improving production efficiency. We're going to talk about that today under process value analysis. What are they doing? Collecting more quotations. Some of them, no solution. Okay, I need to go and help these. All right, maybe you can help. Increase the product price, so they're passing on that cost to their customer. Right? I didn't Google this. I didn't see this on YouTube. Okay, this is my data. Okay, and most of it is only 3-4 months old. Okay, all right, it is very new. Okay. Oh, got my friend online. I should turn off this Skype thing. I can get into trouble with this, but it doesn't matter. Yeah, it's all right. If anything else pops up down here, just ignore it, okay? All right. Okay. It's my social network. It's important. There are influences on demand and supply, customers, competitors, and costs. And I already talked about that. So I want to move on now to the learning objective 2, time horizons and pricing. The key idea here, and this is just a small learning objective, and then we'll move on to number 3 very, very quickly. The key idea here is that in the long run, everything is relevant. In the short run, there's a lot of things out of your control. And so what you include as to be relevant is much smaller. There's a smaller element of what's relevant in the short run. Okay? Short run pricing decisions at a time horizon less than 1 year include decisions such as pricing one-time only special order and adjusting the product mix and output volume. Competitive market. That happens. Okay? All right. What about differences affecting pricing, long run versus short run? What's the difference? Well, costs often relevant for a short run may become relevant in the long run. Okay? Once you've got a machine in place, you can't change things in the short run. You've got to commit. Okay? Here's a real example. Here's a real example. Please take note of this. We have, how many of you know what this is? This is a computer. Okay, those with an iPad, this is what a computer used to look like. Okay. Huh? Are you looking at my website?
It's your nose.
Oh, that's great. I like that. Okay, you're up with it. All right, maybe I should have my iPad too. All right, so what about this one? Do you know what this is? That's a pocket computer. And I did have one of them. I did have one of them when I was young. Okay? And I programmed it in BASIC. It worked. What is this? That's the Macintosh, right? So which one was launched in 1981? This one? Which one in 82? 83? This one? And 84? Macintosh. Yeah, you should know. Didn't you read the biography of Steve Jobs? Oh. Do you do any reading? Yes. Okay. Do you read things that people tell you to read or things that people tell you not to read? I just want to know so I can guide you. All right, this is very important. Okay, so in this really very quick example, this is an example of target costing. So we're working backwards. The relevant costs are $574. $50 is the overhead. And so here's a real example for you need to make a bid to supply 5,000 more items of this computer. How much are you going to bid? So this is information for, okay, you should bid at least $574. Okay, but maybe don't say too high. Why? Because then you won't get the order. You see what I mean? So you've got to have a range. So as a management accountant or an accountant, you may come back to senior management and need to make a decision like this, or production, or marketing, and come to them with information. Give them a range for them to make a decision on. It's not about, oh, the activity-based costs associated with the manufacturing here is this. Okay? You give them a range to work with. And so it's about a range that you go into competition with other suppliers for that product. That's a marketing focus on what costing is all about. It's not cost plus. Okay? There's an opportunity out there. We need to bid for it. Okay, at what price are we comfortable bidding for that product? Are you with me? At what price are we comfortable? Okay, we are comfortable $1 above 574. Are you with me? And if we get every dollar above that is money in our pocket. That's the focus of target costing. That's the focus. It's not cost plus. It's target costing takes into account the market. It takes into account the realities of the market you're selling to. Your traditional costing is, okay, how much does it cost to make? Plus 10%. Now let's throw it out into the market and hope to sell. And let's advertise as much as possible until we sell all the units. Okay, target costing is working backwards. The market reality is this. It's likely you'll win a bid if you're in this range. Okay, can we do that? Should we bid or not? You see the difference? That's the real situation for a lot of companies. That's the real situation for a lot of companies. And so then there's a bit more detail here, because in your lecture notes, the example comes back to Exhibit 12.1, Pro Value, and the total cost of $680. We'll come back to that in about an hour and a quarter. All right? So for now, until 5 to 3, alternative long-run pricing approaches, market pricing, I want to move on, okay, because you can read about that. We talked about the market environment, okay. The big idea is target costing is working backwards from the realities of the market. Everything up until now you've been taught is, here are your costs, now go make a profit. Here are your costs, go make a profit. Should we make this product or that product? Should we sell in India or should we sell in America? Should we have this channel or this channel? How can we make a profit? Okay, target costing and value engineering is working backwards. Okay, it's not about the choice of channel. It's more about the choice of product, function, position. And I'm going to talk about that as we go through with Learning Objective 3. Target pricing and target costing is the center point of Learning Objective 3. You need to be able to price products using target costing approach. What do? You identify an estimated price that customers are willing to pay. Let me give you an example. Amazon has got a tablet, is that right? Is the tablet as good as yours? No. Is it cheaper than yours? Yes. Is it very much cheaper than yours? Yes, yes, it is very. It's about 1/4. Okay, it's very cheap. So do you think Amazon just said, oh, let's make a tablet. Oh, it costs us $70. Let's add on $30 for a $99 sale price. You know, cost plus 40%. No. They will have taken another approach. We have this product with these features. What is the price point we need to sell it at if we want to sell 10 million, 20 million, 30 million of these units? Okay, design team, engineers, factory, go and make a product that we can sell at a 5% profit or 10% profit for this price point. And we want these functions. It needs to have an e-reader. It doesn't have to have a camera. It doesn't have to have a video. It doesn't have to have Bluetooth. Does it? I don't know. Okay, but it doesn't have to have all the functions that this I love the iPad.